Let's bring in Barry Bannister. He's the chief equity strategist at Stifel. Barry, it's great to have you. And I don't know if this is part of a broader macro case or a Bitcoin-specific kind of move that jumps out to you after a lot of the trading damage we've seen.
Yeah, Bitcoin is not digital gold. When you think about gold, when it does well and when it does best historically, it's because of higher than expected inflation with lower growth, stagflation basically. But Bitcoin really behaves more like a high liquidity driven speculative financial instrument, more like a big tech stock.
Right, which if it's just a big tech stock, then you have cash flows. You've got earnings you can argue about. You can, pick it up on the cheap because you know what it's cheap relative to. So continue that analogy a little bit further, because in Bitcoin's case, obviously you can't make those same judgments.
Well, we've seen a big shift, I think, in the last year, and that's what's so odd about it. In the last year, it used to be for 15 years that Bitcoin would go up when the dollar went down. Now the dollar goes down and Bitcoin also goes down with it. For 15 years, Bitcoin would go up when global money supply, this is total money supply in the world, denominated in US dollars, when that thing rose, then Bitcoin would rise. Now it's going the opposite direction. So it is behaving differently. It's not behaving as a hedge against dollar oblivion. It's behaving more like an overextended tech stock that's worried about whether the Fed will cut rates more. And I don't think the Fed's going to cut too much.
So in other words, this is still kind of a liquidity argument. It's why, look, all of this talk over the weekend about Warsh and whether he's really going to have an accord with the Treasury, and is he really going to be dovish, really going to be hawkish? I understand why, if you're in the crypto world, this matters. I understand why it matters to all investors. But for you, is it a liquidity story for crypto? Because even with a fair amount of that going around, look at stocks, they're at all-time highs. It's hard to make the case that we're suffering from a shortage on the liquidity front at the very moment that it's collapsing.
Well, I think that the market's need for liquidity and ever cheaper rates, ever lower Fed funds, ever lower real Treasury yields, either yields after inflation, that was the major driver of PE multiple expansion and one of the major drivers of crypto. Crypto, the only reason to really own it is, for the most part, is that you're betting on the oblivion of the dollar. You're betting on fiat money just going away. It's kind of a libertarian dream, I guess, but I don't think the dollar's going away. And it is interesting that as we can't count on the Fed being the savior to the market, as it has been for 2 years, I think that's a drag on Bitcoin's price.
Why 38K? Why does that number kind of stick in your mind?
Well, we just looked at how it's behaved. One of the best ways to look at any investment or instrument is to look at what it did in previous cycles. We've had 3 major drawdowns in 15 years, and each one stopped at roughly the same point on a chart in percentage terms, slight increase in angle. And that came out to be roughly 38 to 40,000. So, I would just say, hold on, be careful, hold on to your britches, because this is a highly speculative instrument, much like NASDAQ 100. And we do a lot of fundamental analysis on stocks. The Bitcoin note was really just to point something out. And it does not look to us like the multiples can be sustained for the broader market. And as the multiples come down, as interest rates are not as cooperative, you would see some pressure on the most speculative elements of the market, and Bitcoin's in that bucket.
And then finally, so for those who are persuaded by this or a little worried about, tech or crypto and so forth, where could they feel more comfortable?
Right now, the market's making a big bet that we're going to have a broad cyclical smooth rotation into, everything from industrials to financials to insurance to whatever is cyclical. Basic materials, you name it. Right now you've got slowing wage growth, weak monthly new jobs created, and hours worked are not really cooperating. So where is the buying power of most consumers going to come from? The response is that it's a K-shaped economy. The wealthy will spend more, but the wealthy have entirely leveraged their spending to rising stock markets. So as the stock market wobbles, their spending will wobble, and we won't have anything, not a leg to stand on. So I think that the slowdown risk, the interregnum, the pause before you get the cyclical rally, it reminds me a little bit of '01, '02. You had to get through that '01 mild recession before you got the '02, '03, '04, '05, '06 huge move in industrials and cyclicals. I think it's a little early to bet on a big industrial rebound.